If you're watching price every minute, you're already late. Most traders don't fail in their first year. They don't fail because they didn't try hard enough. They fail after they believe they understand the market, after years of screen time, after countless strategies, after hundreds or thousands of trades. And that's what makes this dangerous. Because the longer you stay in the market without clarity, the more confident you become in the wrong behaviors. Time in the market creates confidence, not clarity. And this is where most traders get trapped. You start believing that more screen time equals mastery, more indicators equal precision, faster reactions equal edge. But experience without structure doesn't create wisdom, it creates emotional memory. You remember the trades that worked. You forget the context that made them work. You start reacting instead of observing. At this stage, traders aren't trading the market anymore. They're trading their past experiences. That's why two traders can look at the same chart and come to completely opposite conclusions. Here's an uncomfortable truth. Most traders confuse activity with progress. Watching price every minute feels productive. Placing trades frequently feels professional. Being busy feels like you're doing the work. But markets don't reward activity. They reward alignment. The more you shrink your time frame, the more noise you invite into your decision making, and noise feels like randomness. But here's the truth. The market does not move randomly. It moves in cycles. But your experience of the market depends entirely on the time frame you choose to operate from. Short-term traders experience random wins, random losses, emotional reinforcement. A win feels like skill. A loss feels like manipulation. And the cycle repeats. This creates addiction, not consistency. Long term traders' experience makes money with alignment, patience, predictable behavior. Why? Because institutions don't operate on candles, they operate on economic timelines. Banks don't care about 5 minute breakouts, intraday fakeouts, indicator crossovers. They care about capital flow, policy direction, inflation cycles, interest rate expectations, liquidity positioning, and all of this expresses itself clearly on higher time frames. Let me tell you why. Weekly structure matters. Weekly structure is not slow, it's honest. On the weekly time frame, you see where capital is accumulating, where distribution is happening, where price is reacting to macro decisions. Fundamentals don't look random anymore, they look logical. Interest rate decisions start making sense. Risk on and risk off behavior becomes visible. Trends stop feeling mysterious. When your time frame is too small, fundamentals look chaotic. When your time frame is aligned, fundamentals look obvious. Here's the mindset shift that changes everything. The market isn't hard. Your time frame makes it hard. The market isn't fast. Your impatience makes it feel fast. The market isn't against you. You're just operating where clarity doesn't exist. Professionals don't rush decisions. They wait for confirmation. They don't chase price. They position around structure. If this resonates with you, slow down your charts, zoom out, reduce your trades, increase your clarity. Patience isn't passive. Patience is professional. If you want to understand how markets actually move, subscribe to this channel because consistency doesn't come from doing more. It comes from seeing clearly.